Hi, and welcome to this episode of Scientific Investor Series. Today, we are talking about an interesting ratio called dividend yield. Now, this is at one side a valuation ratio, but on the other side, many investors who are looking to invest in equities for regular income also focus on this particular ratio to seek what's the yield that they are going to get from their investments.
True.
So Vikas, let's again start from the basics and let's try and define what is dividend yield.
So dividend yield is the dividends paid out by the company in last 12 months divided by the current share price. Right. So that's the standard definition. You obviously have an exception that any special dividends are not accounted for here. Typically.
Right.
Shouldn't be.
Right.
Yeah. But you have to be careful in many portals or on Google, like when people search for it.
Right.
Many times that is incorporated and sometimes artificially the yield looks very high for some companies.
Right.
So that's because the one-time dividends are incorporated as if they are regular dividends.
So how one should benchmark, like what is a good dividend yield, what is not so good dividend yield, and uh, at what level it indicates undervaluation?
So typically, very long term, if you see the Nifty or Sensex would have something like 1.5% as the dividend yield, right? So for India, that would be like the base. Anything higher than that is a decent dividend yield, right? So anything above 2 is a slightly higher dividend yield than normal,
Okay.
right? And if you cross 3, I think it's really good dividend yield.
Right. So what are the so as a valuation ratio, you just talk about like what could hint at something. If a really high dividend yield, then it is a indication of undervaluation.
True.
In term for an income, for investors who's looking at income from his investments, uh, what is what are the things that he should focus on?
So he needs see, he's depending on income, which means he's got expenditure lined in front of him. So he better get the income which is targeting, right?
Sure.
So when you keep that in mind, then you have to be very careful whether the company is going to pay that dividend or not.
Right.
And there is no law like in a fixed deposit. If you've given money to someone or you've given debt and there is a coupon payment, then the company is going to make, right?
Yeah.
If it's a A-rated or higher company, typically it's going to pay the coupon on time, right? But with dividend, that's not necessarily the case.
Right.
So to ensure that you do get paid because your expenditures are lined up, you have to go and look at the history of the dividend payouts. So number one, let's say last 5 years of history of how much dividend was paid out. Typically, what month do they pay it out, right? Which time of the year, how many times a year? Some companies do pay out 4 times a year. So that's like a quarterly dividend payout. Then what is the quantum? And is that quantum consistently increasing slightly, or at least is it stable? Right. These are some of the things first you have to see. So the dividend payout history. Now, where is the dividend? So that is one thing, that it has to be stable or slightly growing. Second is, where is this dividend coming from? Dividend is coming from the earnings. Company is making earnings, company is getting cash flows, and from that it is paying out the dividends. So there is a ratio called the dividend cover ratio, or you can look at the payout ratio. Right. So dividend cover ratio is earnings divided by the dividend payout.
Right.
Or payout ratio is dividend as a percentage of the total earnings. So it's the same thing. So you actually want a high dividend cover that only a small portion of the earnings is paid out. In which case the advantage is that even if earnings go down in an economic downturn or whatever, still the company can keep paying out the dividends. Right? If they're paying only 30%, and the company is typically making 100 rupees and they have to pay out 30 rupees, even if the earnings fall to 60 rupees or 50 rupees, they can still pay out 30 rupees. Right? So the dividend coverage ratio becomes very important, and the stability of company's earnings becomes important.
Right.
So the company ROE has to be very stable. Company's earnings have to be very stable. Margins have to be stable.
Right.
Then you can depend on the company to
Continue to pay.
continue to pay you out.
Right. I think what will also help is looking at the debt of the company. Like
Absolutely.
if the company has a huge debt, and it might think of reducing its debt, it might start using more of the cash it's generating to start repaying. In
Absolutely.
that case, it may kind of
Reduce the
reduce the dividend
dividends
payout.
also.
And also the capex plans, like how the
Absolutely.
company is planning to grow.
Absolutely.
So if it sees a growth opportunity and wants to invest there, they again reduce or hold the
True.
dividend
True.
payouts, right?
And let me inverse what you said, that if it's a high debt company, you have to be careful. Similarly, if it's a cash rich company,
Right.
you have some safety from there as well, right?
True.
So even if the earnings go away, they have enough cash to continue paying for a year or so.
Right.
Or two.
Now let's talk about the like many people use it as a valuation ratio also, and
Right.
typically it's much easier. Like once you know a valuation ratio, a PE, PB, or dividend yield, you typically you can just go to a screener, screen companies, lowest PE,
True.
lowest price to book, or
Absolutely.
highest dividend yield. But a lot of value traps can come in if you
Absolutely.
just look at these ratios and just look at the screener. Few you have already spoken about, but again, just to summarize for the people who are looking at this ratio as a valuation ratio. So whenever you are using a screener, you are sorting by highest dividend yield to lowest dividend yield and trying to pick the best ones. What are the things that you need to look at?
So if you are seeing very high dividend yield, sometimes normal dividend, like I mentioned, Sensex or Nifty or the market would have something like 1.5 or so, and so many high dividend companies would be 2, 2.5, 3, maybe even 3.5.
Right.
But you will see some companies giving 25% yield.
Right.
So naturally, there is some distress. Most likely, there is something wrong with the company, and that 25% is not coming to you.
Right.
It's just looking like 25% or even 15%.
Right.
Double digit when the normal is like
3%.
Yeah.
Best. Yeah.
So very rarely that double digit. I mean, we had a portfolio which had that, right?
Right.
And it had AAA bonds.
Right.
So that was a very rare situation, right? But that will not happen most of the time.
Correct.
So if you see very high dividend, that means there is a distress in the company. The company is either bankrupt or there is risk of bankruptcy. The news is out and people are extremely negative on it. I would be careful on that front.
Right.
That, or it's like a one-time payout which is there.
Absolutely.
So you can't.
So you still need to look at companies' stability, financial stability,
Absolutely.
their margins, ratios, growth plans, and everything.
All of that.
Not
All
just
of that. Yeah, you can't just look at dividend yield and buy.
Right.
But yes, if there is a consistent dividend payout for very long term, then I think it should typically be taken as a sign of good corporate governance and high quality business. Right. So it does give you some kind of a sense of safety.
So there is one, again, kind of a wrong perception, I would say, for certain companies, that if the dividend payout ratio is high or the dividend yield is high, it's not a growth company. It cannot grow.
Correct. So that, I mean, there is a justification for that, because typically the logic at the board level is supposed to be that if you can't find good return on capital kind of investment opportunities for growth, then you should return the capital to the shareholders.
Right.
So that is the logic. And so companies which have kind of in a saturated market and they don't have the capability to enter new markets, they would typically choose to just run out the investments and keep returning the capital and the returns to the shareholders in the form of dividend. So it is justified, but there are cases where there are companies which do not require capital for growth or very little capital for growth, and their return on capital is extremely strong. The margins are extremely strong, and they have huge growth opportunities, but which do not require huge capex. Now, for such cases, asset light business models, service models,
they'll be paying dividends, and if they are undervalued, the yield will be
also high. Yeah.
So just the last point. So dividend as an investment strategy, again, I think it's not that popular in India
No.
because uh, people don't think that dividend could be significant income generation
True.
opportunity
True.
when it comes to equities. But
Yes.
in US, people invest in companies which are steady dividend payers,
Right.
and they're not too worried about the current dividend yield, but
Correct.
they are looking at the growing dividend
Absolutely.
income coming from, let's say, 5 year, 10 year down the line when they plan to retire. What are your views on that strategy? Like,
Yeah, so first of all, let me address the dividend as income.
right,
See, as we discussed in India, it's like hardly 2-3% is a
right,
very good dividend, right? While your fixed income, fixed deposits would give something like
is
5, 6, 7, even
right,
9%,
right.
right? And some private companies might
So
give even double digits sometimes.
right, and then you have safety, no, like
And
if
then,
you're
yeah, in a fixed deposits,
deposit
it's kind of
given, right,
guaranteed,
yeah,
or that you will get paid,
right,
while the company could decide not to
not
pay out the dividend.
right,
And the yield is so low, right?
mm,
So it doesn't solve the income problem.
right,
Now, coming to US, the typical high dividend company could be as high as 4% also.
mm,
While, I mean, leave the current situation last 2 years,
right,
but otherwise the yield on the cumulative deposits, the CDs they call them,
mm,
right, instead of FDs, the CDs have a yield of 2%, two and a
yes,
half.
true,
So the dividend yield is actually higher than that,
right,
number one. So even the uncertainty of payout, it's acceptable. And nobody is investing in just one company, right?
mm,
You are investing in a portfolio
portfolio,
of high dividend companies. Plus, it's a kind of a mature economy. So
right,
there are a lot of companies which are in a saturated business
business,
model.
right,
So they do have a lot of surplus capital which they don't need at all. And they have that maturity at board level also, that we don't want to compete here,
right,
and they'll just do the payouts. So that is the first part. Now coming to the dividend growth strategy.
right,
So this is a good income strategy for people who need income for, let's say, 10 years or 20
mm,
years. But for people who have even longer horizons, so someone is like, 10 years away from retirement, so if they go into a high yield portfolio,
mm,
then first of all, for next 10 years, the portfolio will be stagnant.
right,
That's okay. But after they retire, they're still going to survive for 20 years or
right,
25 years.
right,
And during that period, the dividend would still be stable.
right,
So that is why they prefer a
mm,
dividend growth strategy,
right,
where the current yield might be low and they
mm,
don't need it because they're
mm,
yet to retire
right,
10 years from now. So during the 10 years, they expect that the dividend
mm,
growth will happen,
right,
and maybe it will double or
mm,
triple during that period.
right,
So the yield currently is low, but on
but
current price, the 10-year later yield is quite high.
quite right,
And so that's something which people do, but we are not excited about it,
mm,
frankly. I'm
mm,
not too excited about that as a strategy,
right,
because it assumes that you just buy and hold a company for more than 10 years,
right,
which in
so
today's environment,
mm,
you don't know, and number of times the fundamentals could change,
right,
and definitely the valuation would change.
correct,
And then it's better off that you adjust the portfolio as the, something becomes overvalued,
right.
you should get out of it and move into something undervalued, right?
Yeah, I
So
think at best it kinds of helps you stay put with the higher quality companies because these
that
are
is
like,
true.
consistently dividend paying. So at
That
least they
is
have a
true.
stable business model, they have predictable cash flows, they have
That is true.
management who is ready
Yes.
to
Yes.
share with the minority shareholders
As of now.
as of now, right?
But 10 years
Yeah,
later, maybe
yeah,
they will be finding it so difficult to
right,
compete that they might not even be able to pay the dividends.
right, right. Yeah, so you cannot just forget, but just buy
Exactly.
and forget. But
Exactly.
even if it is a dividend growth strategy, it has to be reviewed and kind of
Absolutely.
realigned. Obviously, not
And then you
compromising on the
optimize for
dividend.
the dividend, right?
Yeah, yeah,
Or the dollar dividend
the
or the
dollar
rupee
dividend.
dividend.
True. True.
That at least you get every time
Every
you change the portfolio, you still maintain
maintain
the
that.
rupee payouts,
Right.
but adjust the portfolio to gain
Right.
something extra, gain
Right.
some alpha, right?
Great. Great. So I think this should be interesting to hear about the dividend yield as a ratio and what kind of various implications it may have and how to use it with all informed manner. So thanks again for tuning
Thank you.
in and stay tuned for more interesting discussions. Thank
Thank you.
you. So always keep in mind that investment in securities market are subject to market risks. Read all the related documents carefully before investing. And also that registration granted by SEBI, membership of BASL, and certification from NISM in no way guarantee performance of the intermediary or provide any assurance of returns to investors.